When you look at the financial markets, it can feel like pure chaos, right? Just a random jumble of ups and downs. But what if there's a hidden force, something that's always trying to pull things back to order? Well, that idea is called mean reversion, and understanding it might just change the way you see everything. So let's get into it.
So, have you ever seen a stock price just take off, or maybe totally crash? And you're sitting there wondering, why doesn't it just keep going? Why does it so often feel like it hits a point and just snaps back, kind of like a yo-yo on a string? That question, right there, is exactly what we're going to unpack today.
All right, so here's what we're going to cover. First, we'll explain the core idea with an analogy I love, the market's rubber bands. Then, we'll look at the actual tools traders use to spot these things. We'll walk through a quick example, tackle the big counterargument, and finally, wrap it all up with the most important takeaway.
All right, first up, let's really get our heads around the core concept here. It's all about this simple but really powerful idea of a return to balance.
So what are we actually talking about here? Well, here's the formal definition. Mean reversion is the theory that prices and returns over time tend to move back toward their historical average. Basically, the whole idea is that what goes way, way up or way, way down tends to eventually find its way back home to the average. And this is maybe the best way to picture it. Just imagine an asset's price is attached to its long-term average by this invisible rubber band. When some great news hits and the price shoots up, that band gets stretched. When bad news causes a panic and the price dives, it stretches in the other direction. And the crazier the stretch, right, the more powerful that pullback to the middle becomes.
Okay, so if this rubber band effect is real, how in the world do you actually spot it in the wild? How do traders know when something is stretched too far? Well, that's where their toolkit comes into play.
Traders have this whole toolkit of technical indicators they use to try and measure just how stretched out that rubber band is. You're looking at some of the most common ones right here, and really, they're all designed to answer one simple question. Is this price getting a little bit extreme? Let's break down a couple of the big ones.
First up, we have Bollinger Bands. They basically draw a channel around the price's moving average. Now, when the price pops up and touches, or even goes past that top band, traders call that overbought. And when it falls below the bottom band, it might be oversold. It's a visual alarm bell saying, hey, this thing is getting stretched pretty far.
Another huge one is the RSI, or Relative Strength Index. Think of it like a speedometer for the price. If it's reading above 70, it suggests the buying is getting way overheated. The car is going too fast, and it's probably going to have to slow down, right? And if it's below 30, it can mean the sellers are running out of steam.
All right, so we've got the theory, we've got the tools. Now, how do you actually put it all together into a trade? Let's just walk through a really simple step-by-step example. It really boils down to 4 simple steps. First, you got to know what normal is. What's the average you're measuring against? Second, you use your tools to spot an extreme move away from that average. Third, you'd place a trade that bets on a return trip. And fourth, and this is crucial, you have a plan to get out once the price starts moving back to where it's supposed to be.
And to make this even more real, check this out. There's a statistical tool called a z-score, which is really just a fancy way of asking, how weird is this price right now? A z-score of 4, I mean, that's not just unusual, that is a massive statistical outlier. It's basically screaming that the rubber band is stretched to its absolute limit, and the odds of it snapping back are getting really, really high.
Okay, this all sounds pretty good, right? Just wait for the stretch and bet on the snapback. But, and this is a big but, what if it doesn't snap back? This brings us to a huge counterargument, and really the great debate at the very heart of how markets work.
So what happens if the rubber band just breaks? This is the whole idea behind the random walk theory. It's a cornerstone of the efficient market hypothesis, and it basically says that price moves are random. Yesterday's price has nothing to do with tomorrow's price. There is no rubber band. There is no memory.
So this sets up this huge debate, right? Is the market predictable, driven by things like human psychology, where people overreact? Or is it totally random and efficient, where every price is always the right price based on all the known information? Which one is it?
And you can see the two sides laid out here. On one side, the mean reversion folks say that human emotions, fear, greed, panic, cause predictable overreactions, and that creates opportunities. But on the other side, the efficient market camp says, nope. They'd say that big price move isn't an overreaction, it's the market correctly pricing in some huge new piece of information. The mean itself has changed. And sometimes a strong trend is just a strong trend.
So which is it? Is a wild price swing a sign of a coming snapback, a reversion? Or is it a sign that the game has completely changed, a revolution in that asset's value? Let's try to pull it all together into one final takeaway.
It's pretty telling that some of the biggest names in investing have basically built their fortunes on a version of this idea. Take Warren Buffett. Back in the 60s, a scandal hit American Express. The market panicked, and everyone dumped the stock. Buffett did his homework, saw the company was still solid, and bought a ton of it. He bet that the panic was temporary, and the company's real value was the mean it would revert to. And guess what? He was right.
So here's the big takeaway. Mean reversion isn't some perfect law of physics that always works. It's better to think of it less like a law and more like a constant gravitational pull. There is this endless battle in the market between the emotions that push prices to crazy extremes and the simple math that wants to pull them back to historical averages.
And that really leaves us with a big question at the heart of it all. Is the market a yo-yo, governed by the predictable physics of that rubber band always snapping back? Or is it more like a feather in the wind, totally at the mercy of the unpredictable psychology of the crowd? The truth, as always, is probably somewhere in the middle. And honestly, that constant tug of war is what makes the market so endlessly fascinating.